Dividend stock investing. Today's video is an exciting one. Today's day was an exciting day for me. I made 3 purchases. I actually was very active in the stock market today. I made 3 purchases. I added to 3 of the stocks that I already own. I added more shares. And so not every day can be like today, but when I have a day like today and I'm buying a lot of stock, it is always fun because with each share of stock that I buy, I get closer to my goal of complete financial freedom based on dividends. Dividends paying for all my bills. And so the stocks that I bought today were Cedar Fair, ticker symbol FUN, AbbVie, ticker symbol ABBV, and also Chubb, ticker symbol CB. And so the first 2, Cedar Fair and AbbVie, why did I buy them? They have huge starting dividend yields, huge. I think they're deep discounts. I think they're hot dividend stocks, if you will, really good values. And Chubb, I honestly bought because my position is so small and I'm just trying to bring it to size over time. It's not a very exciting stock to buy right now. It's trading at a fair value, I would say, but it was more of a portfolio balancing thing that if I don't buy Chubb now, I'm never going to buy it. But it's also a hedge. It's kind of a hedge, if you will, a risk hedge, because the first 2, perhaps they're a little riskier. The third one, Chubb, I would say it has low risk associated with that one, and so it kind of provides a hedge against the first 2 as well. And so, in today's video, I want to go through these 3 stock picks, why I purchased them today, especially on Cedar Fair. I have a lot of news behind this one, and I have a lot of questions that have come through on this one, especially on my Facebook group, which I'll link to in the description below. So let's do it. Let's get started, everyone. So Cedar Fair, trading at $51.48, that's where I bought it today. And if I take their distributions per year, which is $3.70, divide that by that price I got, 7.2%. 7.2% starting yield, doesn't get much better than that. And they're increasing the distributions over time. Management has said the long-term vision is in perpetuity to grow the distribution roughly 4% per year. So high starting yield, not the highest dividend growth rate, but hey, 4% is not bad when the starting yield is so high. Now, I get this question. I got this question on my Facebook group. Ian, why do you only own one real estate company, one real estate investment trust? That's Realty Income. You guys know that if you've been here for a long time. Huge position I've got in Realty Income, ticker symbol O. People ask me, why do you only have that one? Well, one reason, quite frankly, is I work in commercial real estate, and so I do real estate outside of my dividend stock portfolio, and so I have to balance that into the considerations as well. And I have exposure to real estate being a homeowner, and so I have to balance all of this in terms of diversification. But also, the more exciting answer is I actually do own 2 real estate stocks. One of them is Realty Income. The other one is Cedar Fair. And so we're going to talk about that today. It is a master limited partnership, but it is a real estate company in my opinion. They're a real estate company that earns the majority of the profits from their real estate by purposing it as amusement parks, but they also own hotels, experiences, restaurants. They even now own a golf course, water parks. We're going to talk about this in some of the news that's come out recently. But the way I look at Cedar Fair is I look at it just like Realty Income. Yeah, it's not a real estate investment trust, but that's another real estate company that I own. I love it. It's a top 15 favorite stock for me, even though I just started buying this in 2018. The position that I added today, also in terms of size, I put the most money today behind Cedar Fair because I'm looking to grow that one aggressively. So, I don't want to repeat myself here because I want to optimize your time. I know my videos tend to be a little bit longer, so if you want to learn a whole lot about Cedar Fair, just check out the description below. I have 2 links, one to a video about master limited partnerships, one to a very in-depth analysis of Cedar Fair where you have an Excel spreadsheet that you can download for free that accompanies it. So I don't want to repeat that, but what I do, I want to set the scene here by talking just about a few high-level things about Cedar Fair. So first and foremost, this company is a master limited partnership. And being a master limited partnership, talk to your licensed tax advisor. It's most likely that this company is best suited for normal taxable brokerage accounts. As far as retirement accounts go, there can be complications by holding a master limited partnership in a retirement account. So something for folks out there to be careful of and to consult the right tax advisor about that. Now, also being a master limited partnership, this is a flow-through entity. And so what that means is instead of paying a dividend, it pays a distribution. And instead of all the normal like qualified dividends and normal tax reporting, what happens around tax time is you get a K-1 from this company. A K-1 is a statement that comes to each of the limited partners for Cedar Fair around tax time, and it shows you a few things. It shows you, most importantly, your share of the profit or loss. And so what this is it is literally a flow-through entity. And what that means is when this company earns money and it flows through to a limited partner like myself, based on the shares, the units that I own, I'm going to pay my percentage of their taxable income. Now, thankfully, in 2018, this company lost money because they had a huge amount of depreciation that canceled out profits. And so we'll talk more about that in a minute. But basically, this stock is equipped for someone who's tends to invest in a taxable brokerage account and also is comfortable with a little bit of extra tax paperwork like I am. I already do K-1s outside of my dividend portfolio, and so I'm comfortable with K-1s. And so just something to point out, whole world of knowledge on this in the video I linked to below. Now, also around Cedar Fair, what's interesting about this MLP structure is when distributions are paid, they are treated as return of capital. And so what that means is the distributions themselves, they are not taxed. They're not taxed at the time they're paid because they're return of capital. They're returning capital to me. And so this is really cool in a year like 2018 where I got my 7% yield and they lost money on paper, and so I don't have a taxable consequence coming through on the K-1, where basically I'm getting a 7% plus yield without any tax consequence on that yield. That's pretty cool. Now, this will not happen every year. Some years the depreciation may not cancel out all the earnings, and in those years, the earnings are going to flow through on the K-1 in a positive manner, and I will have to pay my fair share of taxes on my percentage ownership in the company. And another nuance is once the capital is returned, because the distributions are treated as return of capital, and each time it does that, by the way, it steps your cost basis down by the capital being returned. Doesn't matter for me because I never plan to sell. But what happens is sooner or later they return so much capital that your cost basis gets to zero. My understanding is at that point and thereafter, taxes on the distributions are actually taxed as ordinary income, which is a higher tax rate than qualified dividends. Again, this is repeating what I've shared in other videos, but I got to set the stage here. And the reason I'm sharing this is complex. That being said, a lot of things in life worth having are complex and are difficult. And so for my 7% yield, I am willing to take on that complexity, but I'm also a finance geek. I like this stuff. I geek out on it. I enjoy it. And so to each their own, and this may or may not be for other people, but I certainly like it. Now, what I want to do next is share, other than just adding to this thing, which I already plan to do, what gets me excited about Cedar Fair right now. I want to share that with you because there's been some huge news coming out at this company. Okay, and so I got my laptop, and as I have in some of my recent videos, and I have jotted down a lot of notes. And so I'm going to go through some of those. I can't remember everything, so I got to jot it down. They just announced their earnings report, and earnings were really, really good. Now, I'm not going to highlight all the numbers here, but I want to highlight some numbers that really stuck out in my mind. Now, keep in mind when you're looking at their earnings report, their fiscal year changed, and so comparing it year over year is really difficult because these precise days that are in the fiscal period have changed. And this is a seasonal company. This is a company that makes most of its money in the summertime, in the nice time. And quite frankly, a lot of their parks, they aren't open in the winter. And if they are, they're just on certain days for special events like winter wonderlands or Halloween fests, things like that. And so, mind you, the fiscal year changed, and so you just can't compare year over year. But what I look at is a normalized compare. And they made an acquisition, actually, of some water parks. And so the way I'm looking at the numbers is normalized. When I look at the same parks last year versus this year, and I look on the same days. And so that's something, just a take home for everyone when you're analyzing earnings reports. So you're looking at numbers. These things happen. Fiscal years change, acquisitions happen. And so this is why for retail, for example, it's so important when analyzing a stock and doing your fundamental stock analysis, you look on a same store sales basis. And so it's trying to normalize things year over year. All right, so the on a same park basis, and it's excluding, they bought these Schlitterbahn water parks in the state of Texas. We'll talk about more of that later. On a same park basis, on a same day basis, revenue is up 4% year over year. And so what's really cool is this business is scaling. This business, it's kind of an old world real estate business, theme parks. Do people still want to go theme parks, or they just want to sit home and be on their iPhone all day or on their iPad? That was an argument actually someone brought up when I brought up Cedar Fair. They're like, well, I understand like Cedar Fair is good and everything, but they were saying, hey, kids don't go to this anymore. They just want to sit around on their iPhones. Well, maybe there's a segment of the population that would prefer to do that. And I understand, look, I love Apple products and I'm an Apple shareholder, but I certainly hope that people who are on the iPhone a lot, at least they take some time to experience some amusement parks, because those are really fun too. And anyways, revenue is up 4% year over year, so this business is growing, it's doing well. And I'm excited to see that, because last year, it wasn't the best year for them because they blamed the weather. The weather was bad, and when the weather is bad, people don't go to the amusement parks, and it's just tough because the amount of days that they actually operate each year are so few that even one day of bad weather can throw these guys off. And so one thing is, I think the company is operating at a higher level, but also the weather is more in their favor this year. So also what was really nice to see is on a per capita basis, spending is up. And so this backs up my last point. Spending in parks is up 3%. And so people who are going just on a per capita basis, the average person who goes to, say, Cedar Point, they are spending 3% more money than they did last year. Also, out-of-park revenue, because they own hotels and restaurants outside of the park, outside of the gates of the park, out-of-park was up 4%. And this is, again, on a same-park basis, excluding the Schlitterbahn acquisition. And so this was really cool. So now what I want to do is go in reverse chronological order and share some news with you, because I think this news is fabulous. The first news that I want to read you is something I didn't even know about. Look, I'm guilty of this. I don't follow these stocks. One of my subscribers, Steve, he's always asking, Ian, how do you keep up with 41 stocks? To be honest, I don't. I do my best, but there's different levels of kind of scrutiny, and some people might want to know every little detail about everything. I do that when I'm first looking at a stock, but then once I own it and some time has passed, I don't read every press release. Look, the whole point of this stuff is passive income. I can't be doing that. And so, hey, maybe that's a mistake I'm making. I should own fewer stocks, but I am comfortable with the amount of research certainly I've done before buying a stock, and ongoing. I feel like I'm doing an all right job. But this is a perfect example how I didn't even know about this news until I was researching for this video. Even when I bought the stock earlier today, I didn't even know about this. But that's why I love these videos and I love YouTube, because you all make me a better investor. And that's what's so fun about this community. All right, so they basically said, and this is just from July 3rd, Cedar Fair acquires Sawmill Creek Resort. By the way, Sawmill Creek Resort, this is not far from their flagship Cedar Point park. And this is their main amusement park. And so here is just a snippet of text that I copied from the press release. This goes to show how expansive of a real estate portfolio they own, how this is a real estate company. Sawmill Creek spans a total of 235 acres, including 28 acres of premium Lake Erie waterfront with a marina, a half-mile beach, and 50 acres of undeveloped land. Amenities at the resort include indoor and outdoor swimming pools, 3 restaurants, a conference center, an 18-hole Tom Fazio-designed golf course, and club, and the shops at Sawmill Creek. In addition to golf and swimming, guests can choose from a variety of on and off-premise activities ranging from water sport rentals and fishing charters to a sunset cruise on a legendary Sawmill Explorer. And so what I am trying to paint a picture of here is, yeah, it's an MLP structure. Yeah, it's an amusement park company, but hey, what's the difference in me owning this versus owning a REIT that specializes in hotels? Very little from a technical standpoint, quite a bit because it's an MLP, but from a philosophical level, very little. And so what I'm trying to say is this is a real estate company. That's one of the things I love about this company. I love the raw land that they own. I love the undeveloped land. I love the diversity of the land that they own. Just hard assets, real estate. I love it. And they are using the real estate in different ways to churn out profit, churn out cash flow that they just distribute it out because that's the purpose of this business, the charter of this business. Other than making people smile, which I love, that's the best thing is they make so many people smile. But this is a real estate company. And so in terms of my dividend stock portfolio, 2 real estate companies, this being one of them. So I want to move on. More news. This one is about Schlitterbahn. So on July 1st of 2019, it says Cedar Fair completes acquisition of 2 iconic Schlitterbahn water parks in Texas. They paid $261 million. And here's another snippet I copied. It just says, with the completion of the transaction, Cedar Fair's portfolio now consists of 11 amusement parks, 4 outdoor water parks, an indoor water park, and resort accommodations, totaling more than 2,000 rooms and more than 600 luxury RV sites. I didn't even know that about them, that they had RV sites as well. Combined, the 15 parks and resorts will entertain more than 27 million guests annually. So, again, I love this. I just love this. I can't get enough of this. 27 million people annually are going to Cedar Fair experiences and they are smiling because of it. They're enjoying life because of it. And it's growing. Revenue's growing. Attendance is growing. And so I love this company. But one thing to point out on their acquisitions, they do seem to be going acquisition heavy here. Maybe that's a good thing because they're able to take advantage of interest rates, which are really low. And so also is AbbVie with their acquisition of Allergan. And I've talked about that a lot on this channel. That being said, it's a little bit of deja vu with Cedar Fair because the last time they made a really big acquisition of the Paramount Parks, the economy, basically the bottom fell out and the economy tanked. And Cedar Fair tanked and it was hard times. This was the Great Recession. And so hopefully this isn't deja vu and these guys have horrible timing, but they sure seem late stage market to be going a little heavy on the acquisitions. But hey, these aren't too big. This isn't too. The Paramount one was big. It was a lot of money. This isn't so much. In fact, the notes that they took out, I think it was about 500 million. Not too bad for Schlitterbahn, and also for the next piece of news, which is probably my favorite. I'm going in reverse chronological order. June 28th, 2019, Cedar Fair completes the acquisition of the land beneath California's Great America in Santa Clara. This is what baffles me. They bought the land. They've been leasing it from the city of Santa Clara. They bought it now, 112 acres. They bought that for $150 million from the city of Santa Clara. Talk about a steal. This may not seem like a steal if you're outside of the Bay Area. You may not know where Santa Clara is or where this park is. Basically, this park, it's right in the middle of it all. This is prime real estate, and oh my gosh, I don't know the whole market cap of this company, but it's not big. It's like, say, 3 billion plus or minus range. Somewhere in there. It's small cap, and it's probably one of the smallest companies I own, if not the smallest in terms of market cap. Another reason I like it. But the value that they extracted here, that they got this land for only $150 million, 112 acres, prime Santa Clara, I'm surprised they were able to negotiate that with the city of Santa Clara. That is just such a sweet deal. That land alone, especially if it could be used for a different purpose, such as housing, office space, retail. It probably won't. There's probably stipulations around this purchase, and that's fine. But I'm just saying the raw value of that land, it is in my opinion, probably up there with the market cap of, maybe I'm exaggerating, but it's of the whole company. Basically, it is up there. It is significantly more than the $150 million that they paid for it. Oh my goodness. And so, again, this is a real estate company. That real estate they own in prime Bay Area and that kind of acreage in one spot, one plot. Oh my goodness. And so, look, I am excited about this company. I like it. Now, I'll tell you, people ask me, Ian, is the company losing money? I looked at look on Yahoo Finance, their earnings doesn't cover their dividend or this and that. Oh my goodness. Watch my videos. I'll link to them in the description below. This is a real estate company, so GAAP EPS doesn't make sense because they have depreciation. They're depreciating assets very quickly and aggressively as per what the tax code will allow, and that throws off the GAAP EPS. Now, what I do in my own analysis, which you can download from my other video, is I find the true cash flow. I find what the true cash flow of the company is. And mind you, my cash flow does account for capital expenditures because, yeah, they're depreciating stuff aggressively, but they also have to put money into it because there are CapEx. Look, hotels need to be refurbished, amusement rides, they get outdated, you got to get new ones. And so there's a lot of CapEx in this business, huge CapEx. And so I account for that. But my true cash flow, you'll see, it covers the distributions. And so in my analysis only goes up to 2017, and you'll see it's very close. The cash flow distribution's real close. 2018, it did flip-flop. I know in 2018, at least when I was looking at this, I did not update it for this video, but it was that the distributions were slightly larger than the cash flow. It's because 2018 was just a rough year. It was a rough year at the weather. It seems, based on what I'm seeing so far from 2019, that we're going to be okay in 2019. It should be that the distributions are covered by the cash flow, and certainly 2020. And so it is one of those things though where they run it real tight. They run it real tight in terms of the cash flow, the free cash flow that's really available to distribute. They're basically distributing all of it. And so that is just something to keep in mind. But certainly it is covered in the GAAP EPS on Yahoo Finance. It's misleading for something like this because it's an MLP, it's a real estate company, and they have that depreciation that is part of their business. And so next, I want to transition over to AbbVie. And so as it pertains to AbbVie, boy, I actually don't have a lot of notes. All my notes today were for Cedar Fair. But basically, you guys know AbbVie. I've been talking about it a lot. I made a pretty good size purchase today, and so AbbVie, it's getting up there. I will probably only need to make another 1 or 2 purchases to bring it to size. I believe, my lowest price per share yet, which is $64.99, which is the equivalent of a starting yield of 6.6%. Mind you, of the 3 companies, AbbVie is growing the dividend the quickest, and so very quick grower. I don't remember what their 5-year compound annual growth rate is, but it's in my other videos about AbbVie. I'll link them in the description below. But basically, AbbVie, it will never be a huge core position in my portfolio. Cedar Fair is. It's a top 15 stock. It's going to be real big for me. It has to be. With all the headache of the MLP structure, K1s, I got to make it real big to make it worth my time. But thankfully, though, by the way, on this one, I have now been through a tax season with Cedar Fair, and they made it easy. The package I got from them, K1s, they made it easy on me. So that gave me more confidence to buy more, actually. Now, but anyways, with AbbVie, it'll never be a huge core position for me, but I look at this as a stock that is, like Cedar Fair, quite frankly, on deep discount right now. I think the market is mispricing it. I've talked about it at length, and so I just keep buying in, and now I probably have 1 or 2 more purchases. I am reinvesting all my dividends here in AbbVie, but kind of the way I look at AbbVie is at a certain point, say the share price gets back up to like the high 70s, low 80s, and above. At that point, I may not reinvest dividends. I may just take dividends, use them to pay bills. It's kind of one of those stocks for me. It's not core to my portfolio, but I'd love to own it. Plays a supporting role, nice deep discount. And so I know a lot of you out there talking about AbbVie, a lot of people out there buying AbbVie. And so it's just, it's one of those values right now, but it also comes with a lot of risk. I would say more so than Cedar Fair, in that boy, there's a lot of government talk about regulations and changes and reform as it pertains to pharmaceutical companies, this and that, drug pricing, all that kind of stuff. And we've also talked about their drug patent for Humira expiring as well. And so there are certainly risks that come with this company, but gotta buy more. Kind of just going for it because I don't know how long it's going to be this low. And by the way, I didn't even read the report, but I saw the headline. Allergan came out, the company they're buying with strong earnings, so that gave me a little more confidence. Okay, so you're probably wondering, Ian, why the heck is your third stock you buy today Chubb? Chubb, it's not really at a good value. The yield right now is a 1.9% starting yield, and they grow it annually, but not very quickly. Chubb, I love this. I love that I'm bringing up this point because it matters to so many of you out there who are just starting out. Chubb is a company in my portfolio that's really small. It'll never be core, but it's a company that's important to me because it's diversification. It's the only insurance company I own. As you guys know, I don't own a lot of banks. Not a huge fan of the bank sector. It just doesn't excite me. I'll do a whole nother video on that. I get so many questions, Ian, why don't you do banks that much? Well, I do own 2 banks, but it's not a very exciting segment for me. Anyways, I do value the banks I own, and I very much value this insurance company I own because I have to have some exposure to that side of the market. And this basically is a hedge, I would say, as if you will, against these two, because it's low risk, in my opinion, as compared to especially this, but even to this. And it's in a completely different sector than I normally operate, so it just gives me that kind of counterbalancing that I need in my portfolio, which keeps getting bigger. And so at the stage I'm at now, 2 kids, wife, married, family, we, I'm not where I was when I started dividend investing. I have more responsibility on my plate, so I need to orchestrate a portfolio that it can weather any storm. And so that's where Chubb comes in. And but the reason I'm bringing this up is the position I had in Chubb so far is really small, and so I just had to add to it, and I didn't want to really buy more, but I kind of had to force myself to buy more because it's like, look, Ian, yeah, you could put that money in one of these other ones, get more yield now. But if you don't buy Chubb today, you're never going to buy it. And that's what I realized. It's like it's in the portfolio. It's here to stay in the portfolio. And if I just don't add to it, it's never going to get where it needs to be. And then it's always going to be just this small position that is way smaller than my allocation. I don't want something in the portfolio. It's not at least like 0.8, 0.9 of a percent. Ideally, I want everything to be right around 1% or larger. And so this thing was just nothing, minuscule. And so I just came to a realization, like, I got to go for it, got to do it. I ran the calcs on the forward PE. Looked like it was attractively priced at this point. Not great, not bad. Not a discount, not a steal by any means, but I just had to go for it. Now, how does this relate to you at home? I get a lot of questions. I've had some of these coming through recently on YouTube, on my Facebook group, elsewhere, and it's people just starting out, and they ask me this question, Ian, if you were just starting out, how would you look at things? And I'm going to do a whole video on this, by the way, but one of the things I would look at is, yeah, it's nice to cherry pick the values like with Cedar Fair and AbbVie, but also if I were just starting out, it wouldn't be just about cherry picking value, it would be about building core. And a lot of the core that I own, you guys know my core. Hey, download my whole portfolio. Link to it in the description below. You can download the whole thing, and I actually show you in ranking my stocks how important they are to me, 1 through 41. 1 through 10 are the real core. 1 through 15, still kind of core. If I were just starting out again, it's kind of this game where, yeah, I try to pick the values, but also I would identify what's in my core. Sooner or later, I would just start averaging in. And I would start averaging in not to stuff that's overvalued, but stuff that's fairly valued that I know I want in my core. I want it to be a critical part of the portfolio, and I'm looking long-term, 40 plus years out. I know 40 years from now, I'm going to be happy if I own this, that kind of mentality. I just start averaging in, and that's kind of where I am with Chubb. Chubb, it's not a core stock, but the way it is it's like, look, I want it in the portfolio 40 years from now and be happy wherever I buy it now. And I just gonna have to start chipping away at it. And I have to reserve part of my money just for doing that kind of thing. And so thankfully, taking a step back, my whole framework this year was really going after the core and building the core up. And I did a lot of that this year. I bought some 3M, just showed you in my last video, just bought more recently, and that's in my core. Cedar Fair is in my core, but AbbVie, Chubb are not. But Chubb, quite frankly, well, it's not in the core. It kind of answers this question I get all too often is, Ian, if you were just starting out, how would you look at it? And I would look at it kind of in two ways. I would look, what are the values right now? Try to take advantage of those. But I would also take a step back and always focus like, hey, what is my strategy? What is in my core? And I would evaluate the stocks that are in my core. And certainly stuff that is overvalued, I would wait on that. But stuff that's fairly valued, I'd probably start chipping away. And stuff that's undervalued in the core, certainly go all in on that like I have this year on 3M. And so that's how I look at it. But honestly, I'm going to do a whole nother video on that if I were starting over again today. So these are the 3 I bought today. What are you buying? Please share in the comments section below. We have a thriving community here. I'm so grateful. Let's be the best dividend investing community that we can be. We are dividend investing for everyone. This is YouTube's dividend investing channel, dividend investing community. And so let's collaborate. I would be so curious what you all are buying. On that topic as well, I know I have not been responding to as many comments lately. The channel is growing very quickly. We are now 33,000 strong. Thug life. I love you guys. Thank you for the support. Every single subscription, it really means the world to me. It's the greatest way you can thank me for providing this content, my best content here on YouTube for free. And anyways, join the community, but I do want to let you know I'm getting your emails, I'm getting the comments, I read them. I do apologize, I can't address as many of them as I once could, but I'm trying to scale my time to bring you the best possible videos and the best possible community, not only here on YouTube, but on the internet as it pertains to dividend investing. All right, everyone, before I leave today, a disclaimer. I own the stocks mentioned today. I am long Apple, ticker symbol AAPL, 3M, ticker symbol MMM, Realty Income, ticker symbol O, Cedar Fair, ticker symbol FUN, my favorite ticker, AbbVie, ticker symbol ABBV, and Chubb, ticker symbol CB. I own all of those stocks in my personal dividend stock portfolio. Also, before I leave, in terms of a disclaimer, I'm not a licensed investment advisor. I'm not a licensed tax advisor. Please consult your licensed investment advisor or your licensed tax advisor before making any financial, investing, tax-related decisions. Literally just sharing my journey here on YouTube for fun and entertainment. And that is what I'm doing. And so if you want to read also, I have additional disclaimers, disclosures in all of the descriptions to my videos. So again, no advice. I'm not licensed advisor here, just sharing my journey for fun and entertainment. All right, everyone. Thank you again for subscribing if you have already. If you have not, please consider subscribing, and it is the best way you can encourage me to make even more videos. All right, everyone, see you in the next one.